Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, Darren Mitchell, and with me today is Christina Wyatt, wealth coach at Control and Compound Financial. How are you, Christina?
Hi, Darren. I am doing great. How are you doing?
I'm doing great. Today's podcast, we're going to cover it's called a permission slip to spend all your other money. So, what exactly are we going to cover today?
So, that permission slip that you're referring to is actually a death benefit. So, today, we talk a lot about with the infinite banking strategy, all of the amazing things that we can do with it in the early years when we're taking advantage of opportunities, uninterrupted compounding, all of those great things. But today, we want to focus on one other strategy, just one, there's lots of them, but just one other strategy that we use in retirement that focuses on the death benefit. The death benefit sometimes doesn't get a lot of love. A lot of our clients not so focused on it. We're thinking cash, but when you hit retirement, that death benefit's going to give you that permission slip we're talking about today to spend your own money.
Yeah, and spend your own money is really the key there. I don't know if you remember, there used to be a commercial, and it was a bank, and people were walking around, and it was like, "What's your number?" And they had these like numbers on top of their head, like 1.25 million, 900,000, 2 million, and that was how much do I need to save for retirement. But what we find is people in their 20s, 30s, 40s, and early 50s are really focused on a number. Can I save half a million, 2 million, 5 million, 10 million, whatever their number is. But when people reach retirement, it's a much different conversation. Their questions tend to be, how much can I spend a month or a year without running out of money? And really, that's what we're going to try to show you today is it's not about how much money you have, it's about how much money you can spend.
Yeah, that is definitely the question we get. They're not so much worried about that floating number anymore, are they, Darren? Now, I know you've got an amazing example in your number one best-selling book on Amazon, Be the Bank, where you go through what this looks like, and you use the example of Abel and Barker. Why don't we go through that today?
Okay, let me share my screen and let's talk about Abel and Barker, the example I use in my book. So on the left-hand side, we have Abel, person A, and Abel has saved $1 million. And on the right-hand side, we have Barker, and he saved $1 million. Two brothers. Now it doesn't matter how they had that, how they saved that $1 million. They could have sold some real estate. They could have sold a business. They could have just saved $1 million. But for today's exercise, let's just pretend they both have $1 million. Now on the left-hand side, Abel had some term insurance that expired. Like a lot of people, term insurance when they're working and then eventually it gets so expensive they end up canceling it. But he had $1 million and he was able to find a guaranteed investment rate of 4%. So that's going to produce $40,000 for him and his spouse every year, less taxes at a 35% rate of $14,000. So the net spendable income, what this couple can spend every year starting at age 65, is $26,000. And they're going to spend $26,000 every year in retirement for a total of $520,000 over those 20 years. But what allows Abel to sleep at night, what he feels good about, is he knows if he dies at age 80, there's still going to be $1 million left in his account. So his spouse is going to be fine. So this is how a lot of couples end up spending their money in retirement. They're living off the interest because we don't know when each spouse is going to die. Now, on the right-hand side, we've got Barker. And Barker also has $1 million, but he had a death benefit of $1 million in this example. So that could have been just had some life insurance or had an infinite banking policy that had a death benefit that maybe he wasn't too focused on in the early years. But now in retirement, he goes, okay, well, how can this death benefit really help me spend my money differently? So what Barker is going to do, he's going to find the same 4% annual rate of return, but the difference is he has a permission slip to spend his money. So if we just stop for a second and think of that, I think of all the death benefit I have as a permission slip. I know that I can spend my money, my principal, my growth, everything a little more aggressively because if I die and my savings are down, there's going to be a huge death benefit that's going to be paid at my death, that my family's going to be fine. So in this example, Barker decides he's going to take out $73,000 a year, $73,000 a year. Now, this money here is going to cause his principal to go down. You can see his principal's going down each year. He's going to pay the same 35% tax, but look at his net spendable income. 61, 62, 63, 66, 68. First of all, it's going up each year, which would be nice, keeping pace with inflation. But why is this money going up each year? Well, if we look at the taxes, Barker's taxes are actually going down each year. Okay, and again, that will be great in retirement. Now, why are his taxes going down? Well, Christina, if you gave me $100 and I gave you back, invested $100 with me and I gave you back 110, you're not going to pay interest on the full 110. You're going to pay interest on the $10 of growth. So that principal is going to come back to you tax-free. So when Barker is spending this principal down, the amount of money he has invested, say at midpoint here, he has roughly $500,000. So now he has $500,000 earning 4% instead of $1 million for his brother Abel. So that $500,000 is going to earn 4%, which is half of the million. So they're going to pay roughly half the tax that his brother would. But over a 20-year period, this couple now, Barker and his spouse, are going to spend $1.3 million. $1.3 million. But what happens if he dies at age 80? Well, if he dies at age 80, there's only $300,000 in change left in his $1 million he started with. But what happens? Well, his spouse is going to get the $300,000 plus the $1 million death benefit for a total of 1.3. So his family is protected. He has that permission slip to spend money, and really $1.3 million versus $520,000. What's that? 2.5 times more. So, you look at Abel and Barker here, and who would you rather be in retirement? Would you rather spend $1.3 million or $520,000?
I would most definitely want to spend the 1.3 million. I always want to spend more, right? Spend more. I want to be the one that can spend more money for sure. And this looks great. This looks awesome. But one thing that we know about retirement, Darren, is that we don't really know. We don't know exactly what it's going to look like when you go to retire. And one of those big things, you talked about it a little bit, but what if taxes go up? And I say if very lightly, because what happens when taxes go up? Thanks for listening so far. I'd like to take a moment to remind everyone to subscribe to the podcast and leave a rating on your favorite podcast platform. Hit the button on YouTube, and more importantly, if you're finding value from this content, reach out to us on our website, controlandcompound.com.
Yeah, I don't think there's a lot of people that believe we're going to have lower taxes in the future than we do now. So let's look at that example. So I'm going to show now what happens if or when Abel's taxes go to 50%. What kind of impact would this have on each brother? So if you look at Abel, $1 million, 4%, but now at a 50% tax bracket, half that money is going to tax, and now net spendable income is $20,000. Okay, so now the $400,000 is the amount this couple can spend over a 20-year period, 20,000 times 20 years. What about Barker? If we look at Barker on the right-hand side, his taxes went up. And what's his net spendable income? Well, instead of $20,000 a year, 57, 58, 62, 65, 68, okay, much higher. Now, his 20-year total is $1.2 million versus $400,000. So how was Barker able to put up with this tax increase and hardly affect the net income at all? Well, you remember in the first example, the taxes were going down each year. The taxes were going down because Barker was spending principal because he had that permission slip to do it. So when taxes are going down each year, an increase in tax is not going to have the same impact as it would on somebody in Abel's position where they had all their money was dependent on their net rate of return. So now with lower taxes, 1.2 million versus 400,000. So these guys have the exact same amount saved, but one person gets to spend 3 times more in retirement. Another simple question, would you rather $1.2 million over your 20-year retirement or $400,000?
Yeah, I definitely want to be able to spend that 1.2 million. That's a for sure. And we talk about retirement risks. There are a lot of retirement risks out there. We're just focusing on a couple today, but one that I am picking up on in here is that 4% is a bit, to find one of those guarantees out there in today's market. I don't see very many. I know interest rates are on their way back up for sure, but being able to find a guaranteed 4% right now going into retirement would be virtually impossible. What would happen if you could only find the 2% like most people are finding today?
Yeah, so let's look at the example if it was only a 2% return instead of a 4% return. So if we look at Abel on the left hand side, still has the $1 million, but now was only able to find an interest rate of 2%. Well, Abel's like a lot of people in retirement. They put all their kind of eggs in one basket and they say we're going to save in mutual funds, we're going to save in RSPs, and we're going to cross our fingers and hope the rate of return in retirement is what we need in order to produce the income we desire. But what happens if it doesn't work out that way? So at 2%, what kind of impact does that have on each brother? So if we look at Abel, that 2% means now he's only earning 20%, paying back to that 35% tax, $7,000. So net spendable for him and his spouse is $13,000. So they're going to spend $13,000 a year for a total of $260,000. But Barker, all the pressure isn't on the rate of return for him. He has that permission slip, he has that death benefit that allows him to spend his principal as well as the interest. So if we put the 2% interest in for Barker and he still spends his principal, does it have an impact? Sure, it has an impact, but not near as much. Instead of spending $13,000 a year, he's able to spend 57, 58, 60, etc. So over a 20-year period, Barker's able to spend 1.14 million versus 260,000. Again, because that death benefit gave him permission to spend his principal 1.14 million versus 260,000. Another simple question to ask people. Christina, which would you rather, 1.1 or $260,000?
Much rather spend 1.1 million dollars for sure. And it really does show an impact on how you can reduce those retirement risks in a way so many aren't thinking about it, right? We put together these 72-page financial plans, talking about how much we need to save, but really when you're thinking about it, what we know about retirement is that the more options that we have and the more options that we can use, the better off we're going to be able to eliminate or reduce some of these retirement risks. And today we talked about the infinite banking strategy and just one of those options that it provides. We didn't even talk about the cash value at all. This is straight death benefit today. And we talked so much about cash, Darren, so I'm surprised we got through it without talking about it. But just the death benefit here as an option to be able to use in retirement, it highlights how the infinite banking strategy just complements all of the other things that you're doing. It's another option that you really want to have on that table when you go and you're ready to retire.
Yeah, it literally it makes everything else you're already doing, right? There's not a lot of people that only do infinite banking. They have other investments out there, but it makes all your other investments better because it gives you an ability to spend the money differently in retirement with this permission slip. And you talked about cash value and like we're just talking about retirement here on one specific way to use it in retirement. We're not saying this is the way you have to use it. What we're saying is if we give you all kinds of options, we don't know what interest rates are going to be in 20 years when you retire or 30 years. We don't know what the markets are doing. We don't know what inflation's going to be, but we kept pace with inflation here. Our money was going up each year. Interest rate change didn't really affect us. Tax increase really didn't affect us. So again, it's those options. But just back to the cash value one last time. We talked about retirement, but you and I know what the power of this infinite banking strategy is. And if Barker had an infinite banking policy all along, I would argue he would have way more than $1 million in retirement because the ability to use his money as well as save for retirement, multiply his money, have your money doing more than one job, etc. my experience is people following this strategy are going to have a lot more money in retirement, and we didn't take that into account today. We just looked at a million versus a million, and you're looking at 2-3 times more income, and you're reducing those retirement risks. So higher income, reducing risks. Just one of the benefits of this permission slip that comes along with the infinite banking strategy. Christina, before we wrap up today, anything else to add?
I want to add that what we're doing here is we want to educate people to think more long term, right? If the end goal is to be able to spend as much money as possible in retirement without worrying about running out, doubling, tripling that amount that you can spend, reducing all those retirement risks along the way. Would the plan be to think of that one number, or should we be thinking about the other things that are going to allow us to do that? We want to talk about how much we can spend in retirement, not just how much we can save. So if we can even get people to, have a bit of a mind shift here and start changing those conversations, I think that's what's so important.
Yeah, perfect explanation. Yeah, it's people are so focused on saving X amount when they should be focused on how can I save so I can have the highest income with the smallest risks and not run out of money. Great topic today, Christina. Thanks for your input. Thanks for watching. Thanks for listening. Have a great day. Thanks for tuning into this episode. Don't forget to like, subscribe, and hit that bell button so you always know when new content is coming out. For more helpful tips and tricks, visit our Instagram, Facebook, or TikTok pages at Control and Compound. If you want to reach out to us directly or work with us, visit our website at controlandcompound.com. The links are in the show notes below. See you next episode.